Welcome to podcast for Topic C on Total Quality Management. This podcast is made for RSM 322, and this is the second in a series of podcasts. Today we will be looking at 4 problems that deal primarily with quality problems, some with total quality management and some with other quality issues. So let us begin with problem 14-4, which is the problem with guest watches. Now, guest watches is a division of Guest Fashions, which is a large international company that designs fashions for those young folks that are very fashion conscious, and the watch division is made as an accessory to the fashion division. However, that while Guest watch division succeeded in capturing a large market, because of their quality problems, many of their suppliers are threatening to stop ordering the Guest watches because there's so many returns and defective watches. So there is currently a real debate and discussion about whether they should install a new quality control system. Now, the first part of this problem deals with the cost and the benefits of increased quality. This problem illustrates that there's an optimum value maximizing level of quality based on the data presented in the problem. Now, based on this data, Guest Watch should adopt a level 3 and thereby increase its annual cash flow by $355,000, going all the way to a level 4 quality causes the watch division's annual cash flows to fall from what they would otherwise have been under level 3. And this table estimates the annual net cash flows for each alternative level. And clearly you can see that the net benefits are highest under level 3. Part B is a question about whether the senior management of the watch division will make the same decision as the senior management of fashions, particularly with regard to quality. Now, one serious problem with the analysis done by Guest Watches is that it does not incorporate any spillover effects from the poor quality of Guest Watches to the other product lines of Guest Fashions. The contribution margin of additional sales only focuses on Guest Watches additional sales, not Guest Fashions additional sales. Because Guest Watches management is only compensated on watch profits, they will underinvest in quality. Given spillover effects to other Guest products, there are additional benefits of quality beyond that in the watch division. Senior management will take these additional benefits into account because they are paid on a firm-wide profit, not just the cost and benefits inside the watch division. Another problem with the analysis has to do with whether a single period analysis can really capture the problem. Low quality has a cumulative effect that takes several years to gather momentum as consumers rely and relay their negative experiences to friends and relatives. The word-of-mouth negative publicity is hard to capture as a single period phenomena. So Guest Watches then has to do more thinking about how to design their evaluation systems so that the people responsible for quality will be rewarded for it. Now, the next problem that I've listed for your consideration is Sterling acquisition. In this case, you're working for an investment banking firm, and one of your clients is examining the possibilities of purchasing a parts supplier that makes specifically taillight assemblies called Sterling Manufacturer, and Sterling supplies taillight assemblies to the automobile industry. Your client has asked you to evaluate Sterling, which is privately held, and indicate how much should be paid for it. It has a batch manufacturing process, and they also want to know about the effects of installing a just-in-time production method at Sterling if the acquisition is completed. So your boss asks you to write a memo that outlines the various likely results if Sterling adopts a just-in-time production system and the likely impact on their cash flows and eventual market value. Now, adopting a just-in-time system will affect Sterling's cash flows and firm value in a number of ways, including reduced inventory levels. Now, this leads to a higher return on investment. Excess investments in inventory do not yield returns. Reducing inventory levels will free up the non-interest-bearing investments and allow these funds to be put to more productive uses inside and outside the firm. And the data you require to figure out the impact will be the total dollars invested in inventory and an estimate of the minimum amount of inventories needed to operate an effective just-in-time plan. These last data will probably require outside expert benchmarking. Now, lower inventory handling costs. Operating costs of material handling, warehousing, and so forth can be cut, and thereby increasing operating margins. Now, the data you require to calculate how much of an increase that potentially exists is to look at the total dollars currently spent on material handling for various functions. Another area of improvement can be made because the accounting system is now simplified. Now, just-in-time reduces or eliminates the need for numerous accounting entries to track inventory transactions from raw materials through WIP through finished goods. The data required that you really have to look at for cost savings is the payroll of the accounting department. Now, additional processing costs is an area of potential cost savings. Adopting just-in-time accounting procedures does require changing the date of software. Now, the data required is, can the current accounting software run just in time? And if not, what are the acquisitions or conversion costs? Because that could actually end up increasing the overall processing costs of the company. Now, inspection costs. Just-in-time systems require a change in quality control techniques. Instead of inspecting quality of incoming goods and parts, supplier quality is certified at the supplier's site, not when the parts are received. Also, the quality of Sterling's production process should be improved to eliminate or reduce the need of production line quality inspections. Now, the data required to price this particular saving is knowledge of the amounts currently being spent on inspection and how much is required to be spent on customer certification and process improvements. The last area of savings is in the purchasing department. The purchasing department sales or savings may be significant as just-in-time plants rely on fewer suppliers and long-term sole sourcing contracts to better manage the quality of supplied materials. This leads to fewer purchase orders and fewer purchasing agents. The data you require to put a price tag on this is purchasing department costs, and you also need benchmark data on the purchasing department savings of other firms adopting just-in-time. So the results of adopting a just-in-time system can offer quite a few cost systems to a company that's willing to spend the time in the adaptation. Now, problem 1410 involves total quality management at the Stowbridge division, which already has a total quality management program in place and is thinking about expanding it. Now, one of its customers is asking that all suppliers become ISO 9000 certified. Now, this we have talked about in class is a certification process that indicates the firm has met various standards that are established on an industry basis. Now, once suppliers are ISO 9000 qualified, they can reduce their inspection costs. Not all of the suppliers will be certified, and those that are will receive more business. So, I guess the real question that we're asked to address is, should Stowbridge seek this certification? And your answer is expected to be backed up, not unusually, by quantitative analysis. Now, there's two ways you can go about this type of analysis. You can use incremental analysis, also called relevant costing. This subject was covered in RSM 222. We've talked about it briefly when we talked about capital budgeting decisions, again in 322. So you can use incremental analysis to determine that the net additional contribution for ISO certification is an increase in income of $141,500, or you can use a different approach where you actually look at the effects with 9000 certification and without 9000 certification. The difference between the two being the $141,540 that we saw in incremental analysis. Now, the underlying point that this problem drives home is that the decision to increase product quality is like all other business decisions. It requires careful analysis of costs and benefits. Stowbridge should seek ISO 9000 certification because it increases the firm's net cash flows. The manufacturing cost of $2.05 a unit is fixed since the firm has excess capacity. So note that these fixed costs are irrelevant in the decision to seek the ISO 9000 certification and to expand capacity. The next problem that I'd like you to consider is problem 414, Tagway 4000, which is a computer manufacturer that's based in Miami. And the question involves the internal batteries. The division that produces these batteries, 1 million of them a year, is treated as the cost section, a cost center, sorry. The manager of the division is compensated based on her ability to keep costs low and to meet the quality control measures of the numbers of defects and delivery times. So she has a base salary of $144,000. She's eligible for a $34,000 bonus if the costs do not exceed $2 million. So the question is, first of all, to create a table showing production costs for defects rates at various levels, and do not include the manager's salaries. So with a delivery time of 4 days and defects of 1,032, we have the lowest minimum recorded costs. At 1.550 million. With a delivery time of 4 days. For Part B, you're asked to create a table showing the manager's compensation for defect rates of 1,032, 500, 150, and 32, with average delivery times of 1 to 4 days. So when we take a look at the manager's compensation, so here's a sample calculation for 1 day and 32 defects and 4 days and 50 defects. The basic production costs are fixed at 1.550 million, or 1,000,000 units times $1.55 per unit. Quality costs are 450 multiplied by the difference between 1032 and actual defects. The cost for 32 defects is 450,000. The cost for 50 is 441,900. Delivery costs are given as 300,000 for 1 day average and 0 for 4 day average. So the manager's compensation then is highest at the 4 day and 32 defect level. So although this represents, this is not the ideal or optimum number of defects from a corporate perspective, from a manager's compensation perspective, that is the number of defects that she will be aiming at. And there's an example of the calculations for 1 day and 32 defects versus 4 days and 50 defects. Starting with her base salary of 144 and indicating components of her bonus for a total of 206,000 at the 30-day defect level. Now, the Part C of the problem asks you to comment on the ideal defect rate. In order to minimize costs, the managers would not want to spend any money on decreasing the defect rate or increasing the delivery time. However, the incentives in your compensation package are set such that her compensation is maximized when the delivery time is 4 days and there are 32 defects. Interestingly enough, at 32 defects, if she were to decrease the delivery time by 1 day, her total compensation would drop, but then if she were to decrease the delivery time by a second day, her total compensation would increase. Obviously not above the compensation for the 4 days, which is the maximum. So in Part D, we're asked to assume the company as a whole can measure the financial losses related to defects and late deliveries. And they're asking you to create a table showing the firm's total costs, including production costs. Now, again, the delivery period ranges from 1 to 4 days, the defect rate from 1,032 down to 32. And you can see that overall, with total costs including production costs, defect costs, and compensation, the 50 defect level and the one-day delivery results in a minimum total cost of $2.48 million. And a sample compensation here at the one-day 32 and 4-day 50 defect level. Uses the cost of the compensation that was calculated in the last part of this problem. Now, the last thing you're asked to comment on are the optimum delivery times and defects to achieve the minimum costs. The compensation package is currently set up in such a way that the manager will make suboptimal decisions. The cost of lowering the delivery time would make the manager ineligible for the bonus for keeping costs down. Since the bonuses for costs is higher than the bonus for delivery, the manager allows the delivery time to be longer than desired. One should note that at the 32 defect level, the company is giving the manager some profits associated with the low defects. That is the bonus for hitting 32 defects is higher than the marginal savings for the firm of going down from 50 defects to 32 defects. This sets the ideal defect level at 50 defects regardless of the delivery time. So the simple answer is to lower the bonus awarded to the managers for meeting the defect requirement. However, simple math shows that the actual savings per defect removed is only $10, 460 minus 450. Therefore, the marginal savings for removing the last 18 defects, 50 minus 32, is only $180. Any bonus over $180 is a loss to the firm. Secondly, if the bonus is below $22,000, the manager's maximum compensation changes to 2 days and either 500 or 1,032 defects, or 1 day and 1,032 defects. This fact stresses that the compensation system is not flexible. There is no bonus for barely missing targets. This means that if the manager thinks she's going to miss, she might as well miss by a lot to make sure that she hits her other targets. Or, as in the case just described, if the bonus for meeting the defect target is too small, then there is an advantage to substantially missing the target so that she can hit the delivery target and still meet the cost target. By using a scaled bonus that increases as she approaches the targets, this incentive problem can be solved. So I hope that looking at these problems has made you more aware of the cost of quality and how sometimes the manager's evaluation is not structured to reward actions which increase the quality of the goods. So this is the end of podcast 2. The next podcast will cover topic D.